So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, welcome back to The Daily Call. On today's Daily Call, we're going to talk about a classic options trading mistake that maybe a lot of newbies fall prey to, and it's called when you're right but still lose. And this is actually reminds me of like when I was a kid with my sister. I only have one sister, love her to death, but we used to fight a lot as kids, obviously. And all the time when we were fighting, if I was doing something or she was doing something and, we got into an argument, my parents would come up and they would basically reprimand us both, and they would say, you're both wrong and go to your room. And it would drive me crazy, honestly. Like still to this day, it drives me insane because most of the time I was probably right. And so they would send us both to our rooms because we're still fighting, and so we would still both lose, even though maybe I was right, maybe she was doing something wrong, or maybe I was doing something wrong, who knows, but most of the time I was probably right. Anyways, the reality though is that it can be really hard when you're trading and you get things like direction right. And so this is a classic trading mistake that I think a lot of people make when they start out, is they think that options trading is one-dimensional, because the reality is that stock trading is one-dimensional. In fact, most investing is one-dimensional. I think probably real estate's probably another good analogy for something that's multi-dimensional investing, meaning you generate cash flow in different avenues. Like real estate, it's, the cash flow on the property, it's the appreciation of the property, depreciation, taxes, etc., tax write-offs. But in stock trading and futures trading, forex trading, penny stock trading, day trading, etc., it's all one-dimensional, meaning that you only generate money by buying securities and selling them at a higher price, or selling securities and buying them back in at a lower price. One-dimensional. You can only make money one way, and that's directional movement. And so when people get started trading, they think that that's the same thing with the options market, but the options market is multi-dimensional. And in fact, the dimensions are much more important when you factor in things like time decay and volatility decay, or just the impact of volatility and time decay on the option contract. So it's no longer just if the stock moves in my direction then I make money. It's also how far did the stock move in my direction? How much time did it take? What happened with volatility? We've often seen a lot of examples, and probably earnings trades are the classic example of this, where a stock makes a huge move, but the volatility collapse that happens right after an earnings event decays the premium down. That overshadows any move that the stock might have made. The stock might have made a 5% move or a 10% move in a single instant, but that move was either expected or was expected to do more than that, and so volatility drops and the option contract values drop. We actually recently did a podcast on this on the regular weekly show that we have at Option Alpha, where we talked about these expected moves through backtesting that we've seen. And we know that these expected moves, they're always too great than what actually happens. Meaning the market always over expects a stock to move in one direction or another, and the market or the stock never moves as much as people expect it to move. And so this is a great example of how you can be right in expecting a big move or a big directional move, but still lose in your option contract. So the key takeaway, really on today's daily call, because I see this a lot, and this is why I wanted to get this podcast out today, is just to understand the other facets of how you can generate money or not with option contracts, right? Just like what are the levers that you can push or that the market pushes that enable a contract to go up or down in value. And again, it's not just the directional move in the stock. It has, time decay implications, gamma implications as you get closer to expiration, volatility implications, etc. So you have to understand those components. And it's not a bunch of, you don't have to do a dissertation on it to understand it. They're pretty easy to understand once you get into the education a little bit. And we've got obviously, education and free training on Option Alpha that helps guide you through this. So again, it's really important that you understand just those components of an option contract. So hopefully this helps out today. As always, if you guys have any questions or comments, let me know in the comments section. And until next time, happy trading. Thanks for joining us on The Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on The Daily Call from OptionAlpha.com.